market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London. Happy Friday, everyone. Now, the dollar weakened. US stock futures slipped, as I mentioned, as traders prepare then for the US jobs data that may determine the size of a Fed interest rate cut this month, September the 18th. It's in your diaries. We're going to be speaking to Vasiliki Pachatouridi from BlackRock International about that story. Get the market analysis in just the next couple of minutes. But to set things up, let's bring in Bloomberg's Paul Dobson for the MLI view on how markets are adjusting and the sensitivity around this non-farm payroll print, arguably the most important of the year. Paul, how are markets pricing for this data drop from the US?
Yeah, well, I would have said to you, if you'd asked me a couple of hours ago, Tom, that the market was very much skewed towards the risk of a negative number. If you were looking in FX markets, you'd see that the measures of implied volatility are elevated and they're pointing towards the risk that the dollar will continue to sink. That said, we've seen a pretty big move in the last couple of hours in the markets already in that direction. The dollar coming under pressure right across the board, particularly against the yen, where one of the key pressure points is. So that moderates things just that little bit, but it does seem that the market is preparing for the risk that it's going to be another negative number, another disappointment, one that not only points to the idea that the Fed is going to cut interest rates by 50 basis points to start things off, and that's going to weigh on yields and the dollar, but also that it's going to paint a negative picture for the US economy and damp that demand for equities too.
OK, I was going to follow on that, Paul, because I'm wondering whether we have clarity as to whether or not a jumbo cut, 50 basis points from the Fed, would be positive for equity markets. In the context you've laid out for us, softer dollar, lower yields, a 50 basis point cut, if that's what we get, if that's what the data sets us up for. Talk to us about why you think that may be a drag on equities.
Yeah, and I think it would be. I think that what matters is the kind of projection that we get from the Fed about the state of the economy, the confidence that they're doing. If they're cutting by 25 basis points from a position of comfort, if they're saying, we think that policy is restrictive, we think that we can begin to cut at our ease in order to sort of, lighten up a little bit that pressure because inflation is under control, but the economy is holding up, then the market can take confidence from there. It can think, OK, then equities can continue to rally. If the Fed is thinking, oh, hang on a second, this is starting to look bad. And remember, they've told us they don't want to see any more of a depreciation or a degradation in the outlook for the labour market in particular. If they cut by 50 basis points, that sends quite a different message. That tells you they're worried about the economy. And the market might start to think, hang on a second, what do they know that we don't know? Maybe we don't want to be holding equities anymore. And so I think that messaging from the Fed is actually going to be something that the market will feed off. And that's why, even though on the face of it, maybe a deeper cut would be more supportive for markets, actually the impacts might be initially at least a knee-jerk reaction to sell stocks rather than buy.
Bloomberg's Paul Dobson setting us up for the data out later from the US, of course. In terms of the non-farm payrolls and the potential market reaction, Paul, thank you. Let's get more analysis right now and bring in Vasiliki Pachatouridi, head of EMEA iShares fixed income strategy at BlackRock. Vasiliki, let's start there then. Do you agree with the analysis of Paul Dobson? What would make a Goldilocks number from this non-farm payroll sprint?
Well, good morning, Tom. Well, it really feels like a back-to-school day for macro today. As you said, this is the most highly anticipated U.S. Jobs report. I do agree it's going to give us more indication about whether the Fed is going to cut 25 or 50. But let's get down to the numbers. I think the market is expecting about 165,000 print. I would say if we get anything south of that, let's say under 100K or 75,000, that could prompt a 50 basis point cut. But this is not our base case scenario. I would say anything between 114, the previous print, and 165, that would be the Goldilocks scenario that you asked me about. And I would say that would further cement that rate cuts are coming, starting with a 25 basis point cut. But even if we get something slightly above that, I don't think it would change much. It wouldn't certainly change our base case scenario, which is that the U.S. labor market is cooling but not collapsing.
Does that suggest then that your outlier view on sub 100,000 would be what leads to 50 basis points? Would that also crystallize in your mind that maybe your views on this U.S. economy and this U.S. labour market are misplaced? Would that get you to reassess your otherwise relatively benign view on this US labour market? Would that push you into a hard landing take on this US economy?
I don't think so. And you know, we've been through that hard landing, soft landing, now back to hard landing scenario this year already. I think the market is pricing too many cuts right now. If you see at the U.S. Yield curve, they're pricing something like 100 basis points until year-end, 200 basis points until next year. We are more hawkish than that.
So they're pricing in too much because the economy is actually holding up better than the markets expect.
Exactly. I mean, inflation is, if you look at the big picture, if inflation is falling, growth is holding up, rates cut are coming. I think this is a very supportive environment for bonds. I mean, if we take a step back, I mean, we're entering a gradual easing cycle, and for bond lovers like me, this is a good place to be. I mean, quality bonds should do well. We have diversification. The carry trade is live. I mean, we saw investors piling in $100 billion into bond ETFs just in the last 2 months.
Yeah, has that flow got further to go? And has the bond rally around treasuries, around sovereign debt, does that have further to run, given the moves that we've seen already this week?
I think it's all about like kind of the role that bonds can play in portfolios right now. There is certainly more room for the carry trade. You can get quality yield from fixed income without taking too much risk. But you can also look for opportunities to add alpha and performance in your portfolio. And we talked about the U.S. market. I would say over there, we think that the belly of the curve in particular is better placed right now. I mean, we said that the front end is pricing too many cuts. The longer end, it faces risk from the deficit. But that belly of the curve is a sweet spot. But I wouldn't forget internationally that there are opportunities elsewhere. And dare I say, we have more of a preference for Eurobonds right now than dollars.
This is the cool. OK, so Italian BTPs. You have a preference for Italian BTPs over bonds, over French government debt. The French story, of course, is idiosyncratic to some extent. But what is the case behind wanting to load up on on Italian BTPs? Yeah,
so the first step is to talk about why euros or sterling beyond over dollar right now. And I would say it comes down to that mispricing, the disconnect between markets and macro that we discussed. The market is expecting 4 cuts in the US versus 2 cuts for the ECB, which I think is realistic. So it is about that kind of more realistic scenario for the ECB. But further than that, even more structurally, real rates in Europe have turned positive. I mean, it's been now since the end of 2022. And then even when we look at within the European rates market, yes, Italian BTPs, the spread of BTPs versus core EGBs has been very stable. And I would say even politically, Italy seems to be quite stable right now. And even some of the macro data that we see in the periphery, dare I say, they look more positive than some of the German manufacturing data, for example. So definitely we see flows into European government bonds. We see flows into European investment grade ETFs, actually.
So investment grade, the love is still there, as you say in your notes for us, for investment grade credit. We're going to have to wrap it up. You have some great calls there. So the love's still there for investment grade credit. You got a call there in terms of leaning into Italian BTPs and the preference of Italian BTPs over bonds and OATs in France. And the belly of the curve when it comes to US Treasuries is where you want to be sitting in this environment. The Fed and expectations around Fed cuts slightly over their skis, the markets at this point. That is the view from Vasiliki, Pachatouridi, the analysis there from BlackRock. Vasiliki, thank you. Coming up, a new Prime Minister then for France as we talk about OATs. We're going to discuss Michel Barnier's appointment with the Executive Director of Geostrategic Business from EY and the risk premium on politics that continues to be priced in to French assets. That's next. This is Bloomberg. Welcome back now. The new French Prime Minister, Michel Barnier, has made a plea for political parties in that country to work together in order to move beyond uncertainty. France, of course, thrown into chaos more than 2 months ago after President Macron called a snap election. Speaking after his appointment, the PM said his new government will act more than talk.
We will act more than talk. We'll try to find solutions coming from everywhere. The government will not pretend to have a superior knowledge. I have learned in my long public life that good ideas come from everywhere, often from the bottom, the most humble of people, when you take the time to listen to them.
Right, for the analysis on French politics and to what extent Michel Barnier's appointment moves things forward, let's bring in Famke Krumbmüller, Executive Director in the Geostrategic Business Group at EY, joining us from the French capital, Paris, of course. Famke, thank you for your time. Talk to us about your expectation as to how the appointment of Michel Barnier resets the politics of France and which questions remain, whether it's appointments or setting things up for a budget.
Hi, Tom. Nice to see you. Well, I think there are two aspects to this. From an international perspective, certainly, I think Barnier has great experience. He's a negotiator. He can make compromise. Of course, he's been a long time at the European Union level as a European Commissioner. He negotiated Brexit. So he's very well set up to deal with this extremely complicated political situation in France. We can expect him to, of course, focus on trying to pass a budget, fiscal consolidation, etc. On the other hand, there are many issues in France that will continue to stay. And of course, Barnier will take on this challenge. But I continue to see high risk of instability, inaction, an unresolved question around the strength of the Rassemblement National. So I do think there will continue to be big challenges going forward.
And in your notes to us, one line that stood out was you're likely to see work towards fiscal consolidation from this new premier. But that brings me to the point that you've just made, which is the uncertainty around particular alliances and how much support this new premier is going to get. So how likely is it that fiscal consolidation will be achievable in the months ahead for this new premier?
Well, and that is one of the key uncertainties around the situation in France in general right now. What type of coalitions and majorities will we actually be able to see? They will depend very much on the issue. And of course, the first and biggest challenge for Barnier will be to pass a budget without having the government fall. The left in France is furious about his appointment. They have already said that they will introduce a motion of no confidence against his new government. We will, with regards to the budget, we will see a situation where parties might want to bring the government down, but will they want to be responsible for repeatedly bringing it down is unclear. One point about the budget I think that is important to have in mind is that something like a government shutdown in France is rather unlikely because there are ways to make the previous budget continue as long as Parliament passes the authorization for government to collect taxes and borrow money. So the very extreme situation, I think, is not necessarily going to happen, but it will certainly be a very fraught fall.
Famke, in terms of the potential or the mechanics of the politics and the political setup we now have in France, do we assume that we can get some policy process or we can get some moves around the budget if Michel Barnier aligns with Marine Le Pen's party and Macron's coalition and leaves out the extreme left? Or do the socialists and indeed En Marche, do they need to be bought in, or at least the party, I should say, of the New Popular Front need to be bought into this? To what extent is this going to be about the right and the centre aligning and leaving out the left?
It is going to probably be a center-right oriented government. And Barnier, I think, arguably, he is, of course, from the center-right, but there will be aspects, I think, of a technocratic government. And he will now work the next days to bring in a broad range of ministers. That will be the first signpost in terms of who does he manage to bring in. Will there be representatives from the center-left spectrum in France, which I think he will try and do. Will he succeed? That will be the first main signpost in question ahead of the budget. Then the next big challenge will be, as you alluded to, collaboration with the far right Rassemblement National. And there will be elements of the other parts of the majorities that he will need from Macron's party and even from parts of the Républicains that at some point might not be comfortable with too much explicit support from the far right. So you can see extremely complex equations here.
Yeah. Yeah, very complicated, and we're grateful to have you here to walk through it. Very briefly, Famke, before I let you go, we were speaking to an analyst in the markets earlier. He says he doesn't think the risk premium is going to be eroded from French assets anytime soon. What about the business sentiment on the ground in France? Does this improve things, at least in the near term?
I do think in the near term there is some positivity around the fact that we now have a prime minister, that he's an established negotiator, able to maybe forge compromise. That is in the short term. Now, business, of course, make medium to longer term decisions. And what we see is that this extremely high level of uncertainty in France has led business to, for now, pause their decisions. And I believe that business will soon have to see some degree of reassurance and stability. So passing a budget could already go into that direction in order to be able to start to make investment decisions, for example.
OK, with the analysis on French politics and the implications for business, Famke Krumbmüller from EY joining us out of Paris. Thank you very much indeed. Coming up, live pictures from Germany, where Ukrainian President Zelensky is speaking right now, as you can see. That is, he's meeting the US Defense Secretary Lloyd Austin on a really important week, of course, for Zelensky after a major reshuffle of his government, of his cabinet, meeting, of course, with that key ally, the US, the Defense Secretary Lloyd Austin. We keep across this story for you. They are meeting at the Ramstein Air Base in Germany. Stay with us. This is Bloomberg. Welcome back. 9:24 in the City of London, bringing you live pictures right now, though, of the US Defense Secretary Lloyd Austin alongside Ukrainian President Volodymyr Zelensky, I should say, in Ramstein Air Base in Germany. So Zelensky meeting with key allies, key supporters, and pushing again for the delivery of weapon systems, particularly aerial defense systems that he says are urgently needed in Ukraine. He'll be moving on to Italy and meeting with Maloney after this. But you can see Lloyd Austin there, the US, of course, a key military backer of Zelensky, speaking alongside the Ukrainian president at the Ramstein Air Base in Germany. Let's switch focus to the chip story. Broadcom coming out with a forecast that missed analysts' expectations and estimates, and you can see now the stock pre-markets taking a walloping, down 9.4%. This is not the AI part of the business, it's the more traditional part of its chip business, and the demand there softer than analysts had expected, and you can see pre-market the stock taking a hit. Coming up later in the show, low taxes and regulations. We're going to be speaking about Donald Trump's plans for the economy. Stay with us. This is Bloomberg. Good morning and welcome to The Pulse. I'm Tom Mackenzie in London. These are your top stories. The dollar weakens, US futures slip as traders stand by for what could be the most consequential US jobs report of the year. The Fed's Daily and Goolsbee say lower rates are coming as the labour market cools. Emmanuel Macron picks Michel Barnier as France's new Prime Minister, entrusting the EU's former Brexit negotiator to end the political turmoil of the past 2 months. Plus, Donald Trump vows to cut America's corporate tax rate and slash regulation, saying Tesla CEO Elon Musk has agreed to lead a review of federal spending. Let's check in on the markets, of course, on a big day when it comes to the data front and our understanding of the health of the US labour market. US non-farm payrolls dropping 1:30 p.m. UK time, with the estimates on the Bloomberg of 165,000, comfortably above that surprise shock to the downside July number that came through. But the whisper number is closer to 140,000. What's the sweet spot for these markets, and what will it tell us about the pace and extent of those Fed cuts? US futures currently pointing lower. It's been a bleak week as well for European stocks, looking to end the week lower. One of the worst weeks for European stocks since the start of August. Moves still into US Treasuries at the front end. The 2-year at 3.71. Yields down 2 basis points. for the week, down about 20 basis points on the 2-year. The Bloomberg dollar index softer as well, down 0.2%. Yen strength, consequences, of course, for Japanese equities and the Japanese markets more broadly as we look to that potential Fed cut on September the 18th. Brent, 73.21, up 0.7%. But for the week, down 8%. One of the worst weeks of the year, flat for the year. And that's despite the fact that OPEC Plus came out and said they will be pushing back their decision and their added oil into the markets, pushing back by 2 months. Despite that, broadly still weaker across the week for oil. Now, hedge fund billionaire John Paulson says he believes the Fed has waited too long to cut rates, but he reckons the Fed will cut rates soon, which should provide a boost.
My best guesstimate would be around 3%, perhaps 2.5%. It's generally beneficial. The major cost when you get a mortgage is the interest rate. So if the cost of mortgages come down, the cost of buying a home would also come down.
While staying with the US economy, Donald Trump has pledged to cut the corporate tax rate, slash regulations and audit the federal government as he pitched his economic agenda to Wall Street. Trump said he wants to prioritize the country's economy.
To further support the revival of American manufacturing, my plan calls for expanded R&D tax credits, 100% bonus depreciation, expensing for new manufacturing investments, and a reduction in the corporate tax rate from 21% to 15% solely for companies that make their product in America.
OK, for more analysis on what we've been hearing from President Trump, former President Trump, of course, the Republican nominee, and in fact, Kamala Harris, and how it all squares up, let's bring in our senior writer, Stephanie Baker, with a finger always firmly on the pulse of US politics and this election. Stephanie, a lot of questions about the tax rate. He's already moved it in his first term, of course, down to 21%. He wants to move it further in terms of the corporate tax rate. So really dividing that line versus Kamala Harris, who wants to move it up to 28%. What do we know about the impulses behind this decision and whether it's fundable, in fact, and how the business world of the US is likely to receive it?
Well, it's part of his America First agenda. You're right. It's not costed. It's going to cost a huge amount of money. He wants to extend the 2017 tax cuts, which are due to expire next year. And he proposed last night this idea to lower the corporate tax rate to 15% for companies that are producing manufacturing in the United States. But that raised a whole slew of questions of how do you define made in America because of complex supply chains. What do you do about cars or Boeing, for instance, where parts come from all over the place but may be assembled in the United States? There's already gaming of the system on that. There are a lot of questions about his tax proposals. And as you said, principal among them, how is he going to pay for it? Yeah, so that question remains unresolved. But as we mentioned, a clear dividing line now with Kamala Harris. How is that being received? What's it likely to do in terms of poll numbers? Talk to us about the difference that we're seeing in the pitches coming through from these economic policies from both contenders. Well, Trump outlined a populist economic agenda. He said he wants to get gasoline prices down below $2 a gallon, which everyone would love to see. That's a popular policy. Yeah. So he's saying things that voters want to hear, and he is more trusted, according to polling, on the economy than Harris is. And I think that voters have a certain nostalgia for the Trump economy pre-COVID, understandably so. But I think it's hard to imagine we will ever get to that point again. A lot of the proposals he outlined are inflationary. These sweeping tariffs that he wants to impose on foreign goods, 10 to 20% higher on China. And most mainstream economists believe that will cause inflation to jump and perhaps economic growth to slump. So there's a lot of things that don't add up in his economic proposals. Harris, of course, is proposing to raise taxes less than what Biden has outlined. She is under pressure to give further details on her economic vision, and she will probably come under pressure to do so at the debate on Tuesday. OK, and that debate is going to be consequential, isn't it? As we've learned, these debates can be significantly important. You talk about the inflationary impact as well, the decision, or at least the policies around immigration could add to that inflationary impact from tariffs as well in terms of the Trump policies.
On the funding question, the question of funding which we touched on, possibly Trump might say, well, I'm going to cut my way to be able to afford some of these tax cuts, or cut my way in terms of cutting through the federal government. And he talked about Elon Musk maybe having a role there. We'll take a listen to what he had to say in terms of getting the CEO, of course, of X and Tesla involved.
I will create a government efficiency commission tasked with conducting a complete financial and performance audit of the entire federal government and making recommendations for drastic reforms. We need to do it. And Elon, because he's not very busy, has agreed to head that task force.
Stephanie, is he for real?
It's quite incredible. This idea for this commission actually came up during his Twitter Space event with Elon Musk about a month ago. And now he has come out and moved it further and decided to put Musk in charge of it. And of course, this raises all these issues of conflicts of interest. I mean, Musk runs major companies that are either regulated or funded with U.S. government money. Tesla receives subsidies. SpaceX works with NASA. So there are major questions about how he could effectively run a commission like this without, running foul of conflicts of interest.
OK, so that's one potential red flag in terms of that possible appointment then, in terms of overseeing a review of federal spending and the role of Elon Musk. Walking us through the politics of the US, then Stephanie Baker, and the economic policies that have been outlined by both candidates. And we look ahead, of course, as Stephanie said, to that debate next week, which will be top of mind for many. Now, oil is heading for its steepest weekly loss in almost a year, and that's despite, as we mentioned, OPEC Plus members delaying its output increase by 2 months. Let's get more and bring in Bloomberg Horizons anchor Jemana Pasechi, who joins us from Dubai. Jemana, what was the thinking? What do we know was the thinking behind this decision by OPEC Plus to delay the increase in output?
Well, you got to think it's motivated by some of the price action we've seen this week, with oil slumping more than 8%. Brent's getting closer and closer to that $70 mark. WTI actually trading below $70. So there were lots of questions in the market as to how OPEC Plus would respond. And remember, back in June, they announced that these voluntary cuts, the ones that were introduced in 2023 by 8 of the members of OPEC Plus, would start to get slowly unwound as of October the 1st of this year. Well, yesterday they put out a statement saying that the 8 members had a virtual meeting to discuss pushing back that timeline by 2 months. So instead of beginning the tapering of those cuts on October the 1st, they're now going to start on December the 1st, keeping the exact same schedule as they had before, but ending now on December the 1st, 2025. So everything stays as it is. It's just been pushed out a couple of months. So you've got to think that OPEC Plus are looking at some of the price action in the market and feeling a little bit concerned about what the possibility of adding extra barrels back to the market could mean for a market that is already trading quite bearishly. And so what they're doing here is looking to bide a little bit of time. Other notable features from the communique that they put out yesterday is they've also emphasized that they're having some discussions with the 2 overproducers. Those are Iraq, Kazakhstan. Those 2 countries have been pumping more than the quota would dictate. They've talked about the conversations that they've been having in order to urge them to actually stick to the quotas that were instituted, and second, to come up with a compensation plan for the extra barrels that they've been bringing to the market since the beginning of 2024. But of course, that is an important question for the OPEC Plus group. As you think about the timeline into 2025, you've got to think about adherence to those quotas as well, not just the outline of the table of those tapering and the cuts that are expected to come in the next 12 months. You also have to think about compliance.
Yeah, compliance, adherence, does that still hold if we continue to push this back by 2 months? And we know that some members are feeling the pain on this front. What else are you watching for then, Jemana, that's tying in, that's feeding in to oil markets and how they could play out in the weeks and months ahead?
So, Tom, let's just rewind back to the beginning of this week. 2 things happened concurrently. You had weak data come out of China. Those China PMI numbers disappointed to the downside. But simultaneously, you had a geopolitical flaring up. This time in Libya, you had warring governments between the East and the West that led to a shutdown of some of the oil that was coming out of Libya, an impact of about 400 to 500,000 barrels per day. What was the impact on oil? Negative. What does that tell you? It tells you for right now, at this point in time, the market is focused on the demand picture. And as long as the demand picture continues to look bleak, the signals coming out of China disappointing to the downside, softer data coming out of the U.S., further expectations that the U.S. May be looking to enter into a period of not necessarily a soft landing, potentially even a hard landing, all of that dampens the outlook for oil. In addition, you've got to think about some of the seasonals here. We're entering into the refinery maintenance period for some of these U.S. refiners, which means that the overall demand for crude oil is going to drop a little bit. And then, as you were speaking earlier, keep a close eye on the technicals. I was speaking to some options traders yesterday. They say around $70 on Brent. You may see some negative gamma kick in, which means that would put even further downward pressure on the price of oil here. And by the way, Tom, we haven't even spoken about non-OPEC supply, which many have been pointing out for a while now, will continue to increase. You've got more production coming out of the U.S., you've got Brazil, you've got Guyana, which has seen the biggest growth in oil supply growth this year. So all of that adding to some of the negative sentiment that is being factored into the price of oil here.
Yeah, and as you speak, the modest gains that we saw in the session have been erased so far. For Brent, 72.71 right now. WTI still below $70 a barrel. With the comprehensive analysis on the oil markets, Bloomberg's Horizons anchor, Jemana Pasechi, thank you. Coming up, the private equity landscape under pressure. My next guest, though, says there are green shoots of recovery. Adam Turtle, CEO of Rede Partners, is up with us next. Stay with us. This is Bloomberg. Welcome back. Happy Friday. Now, the private equity landscape has been marked lately by lower asset valuations, lower deal making and lower fundraising. That's largely been, of course, due to high rates and geopolitical risks. But my next guest says he is slowly seeing green shoots of recovery. Adam Turtle, who has a touch point on this sector, CEO of Rede Partners, with a number of clients, of course, globally in the UK as well. And we touched on the rate environment. Of course, we're all obsessed with what's happening, where the Fed goes, how deep they go, expected to cut, of course, September the 18th. Talk to us about what a lower rate environment will mean for your industry, even as many wrestle with the question of what the neutral rate is, whether it's 3%, 2% or lower, how that affects deal size, how that affects leverage, fundraising. What are the implications of this current rate environment?
Look, I think the rate environment obviously changed dramatically over the course of the last couple of years, and I think the industry has had to readjust to that. I think there is a general expectation that that we've reached the peak of that, and then rates may well start to come down. At the same time, rates ultimately are a commodity for private equity firms. Everyone benefits from the same financing conditions, and what we've seen over the last few years, decades really, is increasing sophistication of private markets managers around how they find deals, how they select deals, and how they grow their companies, kind of regardless of the rate environment that's behind that. And I think that as a consequence of that, we continue to see great performance in the markets despite whatever's happening with the rate environment. I think should rates start to come down, though, that will start to trigger more deal-making activity, particularly at the larger end. I think private markets is a broad market that covers obviously larger cap, but also small cap. And what we have seen over the last few years is probably more interest and focus on the SME side of the industry, where leverage is less of a relevant component of the value creation journey.
And in terms of exits, capital markets, what do your clients say about their expectations around capital markets and that freeze starting to melt around the edges? Yeah,
we're definitely seeing that. I think again the hardest period I think is when there's a lack of visibility about what's going to happen going forward. I think people have sort of adjusted to that now. Things are still somewhat slow, but there is an expectation that you're going to start to see that unfreezing somewhat. Particularly as rates start to come down.
And on the fundraising front, then, when you speak to clients, either here in the UK or your external and global clients, what are they saying about the momentum that you're seeing in terms of fundraising, and whether that, if there is a pickup, that can be sustained?
So I'd say, we were a couple of years ago in a period that was extremely buoyant for fundraising, very buoyant.
Yes.
I would say almost unprecedented in terms of how buoyant it was, and we actually put data out on this. We have our own data we published.
Was it irrational? Irrational exuberance?
I'm not sure it was irrational, I think, but it was, obviously we were in a period of ultra-low, very loose monetary policy, and so I don't think it was irrational because performance supported it, but it was certainly powered by monetary conditions that were unprecedented, and we're not anticipating are going to happen again, even with a reduction of interest rates. So what we've really seen is a shift from what I would consider almost the blip rather than the situation we're in right now. I've been doing this for a long time. The market conditions we're in right now aren't easy, but then fundraising shouldn't necessarily be easy. And what we are seeing again when we look at the data that we publish is a slow recovery in capital deployment to the segment and a continued real interest from institutional investors in committing to the segment. And
on valuations, where are we there? Is there more catch-up that's needed, that's expected in terms of valuations in the private markets versus the public markets?
I think we are continuing to see exit activity, and when that's happening, the value, at least amongst the client base that we see, those valuations are being borne out in the valuations they were holding are being borne out in the exit activity that they have. Clearly, and we have seen a recovery in valuations in the public markets. If you look at from that perspective. So I think that the valuations, are solid, but I do think that what you really want to see is more deal making because that will trigger more exit activity.
How do you define and quantify the risks within this space, given the complexity of some of the deals now? People like Jamie Dimon and others have compared the private credit markets now to kind of global financial crisis. Is that taking it too far? What is your take on the risks within private credit?
Look, if you're looking at private credit, I definitely disagree with that. I think that, one of the big positive developments is the development of a robust private credit market where you have sophisticated financial investors agreeing to tie up their capital for the long term to support managers who are supporting companies for the long term. So I think there's the asset liability match is there in private credit, and it's a profoundly good thing for economic stability, if you like, that market has developed. I think the underlying investors in these segments are thoughtful, sophisticated, and quite involved and close to their managers. So I think they do understand the risks that are taken. And so I don't see every sector, every market, every ownership structure can have underperformance. That's part of life.
Okay.
But I think the structures and oversight in this segment is actually very good.
Okay. Adam Turtle, thank you very much indeed. An important time to touch in on what's happening in terms of private credit and private equity, of course, as we expect rates to edge lower. Adam Turtle, CEO of Rede Partners. Coming up, how Greece is using technology to live with wildfires that have now become a regular occurrence in that country across the summers. Stay with us. That is next. This is Bloomberg. Welcome back. Now, Greece is experiencing its worst wildfire season in 2 decades. And while authorities are looking at ways to prevent fires, the country is also learning to live with them. Joining us now is our Athens Deputy Bureau Chief, Paul Tugwell. Paul, why does Greece seem to be, at least on some measures, doing better in terms of controlling and managing these wildfires that seem to be becoming an every-year occurrence for this country?
The simple answer is investment in technology. The government announced in April a procurement program worth 2.1 billion euros for buying various pieces of firefighting equipment, but particularly drones, and that's made a big difference this year. These drones operate on a 24/7 basis, flying in Greek skies, particularly over Athens and its greater Attica region where the bulk of the Greek population lives. And they have enabled the fire department to detect fires much more quickly, which means they can react much more quickly, to the extent that they can respond to an outbreak of a fire within 5 to 10 minutes. And that has really helped them contain fires compared to previous years.
OK, so monitoring and the rapidity of the response then from the authorities. Is it a depressing reality that Greece will be seeing more wildfires in the years ahead, Paul?
Unfortunately, I would say yes. Already this summer was the hottest ever globally. The Mediterranean in general was particularly hard hit, and that obviously includes Greece. So we're seeing longer summers, drier summers, with temperatures increasing and above average all the time. But also, the climate change means that we're seeing less rainfall in the winter and in the spring, which means we enter the wildfire season, which officially begins on May 1, in a worse situation every year. The conditions are such that it's easier for fires to break out. Climate change, of course, also means there are other extreme weather patterns that include storms, and we had several of those storms this summer in Greece. You may say the rain should help in terms of extinguishing fires, but in fact they bring lightning, and lightning strikes have triggered many forest fires this year.
OK, Paul, got to leave it there. Paul Tugwell, our Athens Deputy Bureau Chief, checking in your markets on a big day, of course, with the non-farm payrolls print. Bonds bid, equities down. Stay with us. This is Bloomberg.